All right, mic check, mic check. All right, thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. All right. So, today we're talking stock valuation. All right. What have we discussed so far? All right. So, for those that are just joining us for the first time, all right. If you're just joining us for the first time, you will still be able to grasp everything we're talking about tonight. Each of these lessons that we've gone through is a lesson within it, in and of itself, right? That can be applied solely, or that these things can be combined to help put everything together for you. Now, so when it's all said and done, over the past week and a half now, we've had, tonight makes the 7th session for Value Investing 101. All right. So shout out to everybody that's been here each and every one of these nights. Definitely happy to see so many people taking this seriously. We've went through a process of understanding what the different philosophies are in value investing, right? So, the Benjamin Graham style, the Warren Buffett style, the Peter Lynch style, the Petrosky style, right? We've gone through all of these styles and kind of broken down what they're really all about, and the evolution of this entire way of looking at the market, right? As we get to what we currently do here at the Equity Channel. And that's to pay homage to the people that came before us, as obviously we derived a lot of what we do from studying them and studying their work, right? We went through the process of discovering, learning how to discover stocks, right, through screening. learning how to use the results of that screener, because a lot of times people think, oh, if I use a screener and I get a list of stocks, well, all I have to do is start picking stocks out of the screener. No, right? There's a certain way to utilize a screener in a professional manner that actually highlights and targets goals that you may have for yourself. Right? We learned that. And these are things that we're going to be going back over again before this entire thing is over. Every week, Monday, Wednesday, and Friday, we're going to be meeting up to go over this process and this style of investing. So, definitely keep coming back, because if you missed anything, it'll come back around anyway, because we have to go from learning each step in the process to then learning how to walk step by step through the process all in one swoop. And I love to show people how quick and efficient our process is at finding quality names and getting to the point of investing. For those that have been here a while, y'all know, right? We get it done. We get it done quickly. There's not a lot of, hang up in our system. All right. What else have you guys learned so far? You've learned how to essentially, once you've done the screening and utilize the screener in the proper way, you've learned how to research a company and to to actually grade a company, I should say, a buy, a strong buy, give it an outlook. You've learned how to do that. You've learned how to go from grading a stock to finding out as much as you can about the company. And so those are all the things we've done so far. Now today, we're going to go through this process. If you found out as much as you can about a company, now comes the point where you may want to invest. Maybe you said, okay, this stock is definitely a buy. They have a great outlook. It's an exceptional outlook, right? And now I want to buy this company if possible. So tonight we're going to talk about what that's all about. Like, how does that even work, right? And this slideshow tonight is really meant to just show you the particular elements, but then we got to do all the work and digging into really how to accomplish it. Now, pay close attention, because whenever we do these particular sessions, I always come to those who are present to find out how well you really understand what we're doing here. Okay? So that means, yes, I will be calling your name. We are going to do some math together. Okay? So, everybody's phone calculator nowadays, so we ain't got that excuse, right? Let's talk about it. This is essentially what it's really all about, guys. When I was studying finance, right? It was interesting to really find, and I shouldn't say when I was studying finance, I'm still studying it. So I'll say as a student of finance, right? Um, it was really interesting to just discover this one simple idea here. The time value of money was behind almost everything that like that you saw in modern finance. Like, how do you know how much a bond is worth? How do you know how much, a stock is worth? How do you discount cash flows and so on and so forth? So the time value of money is behind all of it. Right? Now I'm not gonna do I'm not going to do discounted cash flows today. We're going to do discounted cash flows on Friday. Well, we'll discuss it. I'll see if you guys are, you know, yes, exactly, right? April, right? So this ties into all of that, April, right? Where you're now saying, I found a great company, what's a good price? So the number one thing about time value of money is opportunity cost. So money today can be invested to earn a return. Waiting for cash has a cost, right? Um, I'm actually gonna read a part of my I'm gonna read a part of my book to you guys tonight as well. A part of that talks about this opportunity cost and this holding of cash. We'll talk about that a little bit. Um, you have the inflation impact. So purchasing power generally erodes over time. So future dollars buy less than today's dollars. And so you need a risk premium, right? There's always uncertainty that future cash flows won't materialize as expected. So I'm going to show you guys how to put together very light, show you guys how to put together very light discounting factors, moderate, and extreme factors as well, so you can determine you know what's the fair value looking like for you. Okay, now the mathematics behind present value are as such, right? So we're looking. This is what we're looking. We're looking for the present value of a dollar, right? What is a dollar worth in 1 year, right? If you think the answer is $1, this is especially for you. If you believe it's certainly not a dollar, but you're not sure how much it actually is worth, same deal. This is for you. Okay, we're going to be discussing all of this. So to calculate the future payment, what a future payment is worth today, we discount it using this particular formula. So the future value, right? R is the discount rate, and then N is the number of years. We'll get to the number of years part in a second. The reality is, most of the times I'm going to have you guys discounting by 1 year, right? It's when we start to learn things like present value of growth opportunities. And these would be like more advanced classes down the line. I'm not going to get you guys into that stuff right now, right? But I am going to show you guys a very short form of discounted cash flows that I taught people back in the day that always worked out pretty well. And we'll do that. We'll talk about discounted cash flows tomorrow. And then not tomorrow, on Friday, and then we'll learn the long form and the short form, but for the most part, I just want to show you guys the short form of it, just to give you an idea of how that works. Now, a second, I was writing something down there. All right, now the cost of equity is essentially the minimum return an investor requires to compensate them for risk of owning a stock. Let's go back. Let's go backwards here. What did it say we need? It said we needed a discount rate. It said we needed a discount rate, right? The discount rate is also known as your required return. In many like models that we use to discount stocks, we use the cost of equity. All right. In many models, we use the cost of equity. Tonight, I'm going to be showing you guys something a little simpler than the cost of equity. I'm going to be showing you how to build your own discount rate. using the things that we talked about a few slides back, right? Opportunity cost, right? Which is going to be the 10% return you can get from the market, right? The impact of inflation, which over the long run is supposed to be 2%. And then your risk premium, which we'll talk about different ways of doing that. I'll show you guys a few things here, but you're gonna want to certainly you're certainly gonna want to take all this stuff into consideration, but you wanna have different discount rates that you're gonna work with, and that's what I'm gonna be teaching you guys. Okay, now the 4-step discounting process is simple. Right? You forecast the cash flows for the next 5 to 10 years. Now, the beautiful thing about that is, guess what? The analysts already do this for us. Right? Then you get your discount rate, and you use the time value of money to for each year's individual cash flows. We'll get to that. And then we go to what we call our terminal value. So this is more of your discounted cash flows process. For you, you're really going to need 1, 2, and 3. Okay, you're going to need 1, 2, and 3. You're going to need to figure out your forecast. So analysts already give us the forecast, right? So we don't need to do that on our own. We already have the analyst forecast. We're going to use that. Right? Then you need a discount rate, and then you're going to have to discount for each year of cash flows. But the analyst forecast is for 1 year, so we only need to discount by 1 year. So that's what I meant by that. Okay. So, like I said, we're not going to be doing many slides here. We're going to just get straight to work. All right, let's get straight to it. Y'all ain't scared, are y'all? All right. Don't be scared of the work. I promise you, it's not as complex as you think. All right. So, we talked about what the first thing was that we needed. We needed a forecast, right? We needed a forecast. So we can go to stockanalysis.com. Now, one of the stocks that we had from last night, not from last, from Monday night was what was our number one stock? Our number one stock was Airbnb. I know, right? Hey, Airbnb it is. Our number one stock last night was Airbnb, right? We're gonna go to the see right here. Look, what did I say? You need a forecast. Here's your forecast right here. So you don't have to put together your own forecast. Right? You have the highest forecast price for Airbnb at 181. You have the lowest forecast price at 115. You have the median at 157. Okay. You have the average at 156.34. You can use the median or the average. All right. I'm gonna give you guys your choice today. Put it in the chat on Twitch. What do you prefer? You prefer median or average? Put it in the chat on Twitch, guys. What's your preference? Median or average? I'm letting y'all choose tonight. Cecily says average. Oh, okay. Mr. Biscuit says average. Oh, we getting average, 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 average. And we got one medium. We got one median. So it looks like average is gonna win here. We're going with the average. Average price, average forecast for Airbnb is 156.34. Okay. Now you may come over to the forecast and say, well, they're trading 21% below, so maybe that's good enough. You never know until you know. All right, you never know until you know. All right. So 156.34 is the average forecast. So we're going to put that in here. 156.34. Let me zoom in for you guys so you can see this better. All right. Let's zoom on in. All right. Well, let's just zoom in 200. Why not? All right. There we go. So for those that are joining us for the first time on Clubhouse, if you click that link at the top of the room, you will see it says watch us on Twitch. Trust me. You want to come on over here. You want to check this out. You want to see what we're talking about. Okay. So this is our forecast right here. All right. What's the next thing we need? We need a discount rate, right? We need to figure out how much we need to discount this thing by. All right. And so what do we learn about time value of money? Right. First, we have to consider the opportunity cost. Okay. So the opportunity cost is usually going to be the average return of the market. I'm going to put a little note in here. Watch this. All right. Here's what we're going to do. I'm going to put a little note in here. Where's it at? Insert note. Okay, average return on the market. So if I hover over that, we know what our opportunity cost is, right? Average return on the market. I'm not just going to throw numbers at you tonight. I'm going to show you how to do the research, right? I can go right to Google and say, what is the average return of the stock market over the past 5 years, 10 years, and 20 years? All right. Now let's be clear about something right here, right? Just so we're clear, over over a 20-year period, nobody has ever lost money in the stock market, right? So all those things you ever heard about the stock market, oh, it's a scam, or you know, it's risky, you know, it'll take all your money, all that extra stuff. Let's be clear about one thing. A lot of those people didn't understand the stock market. So they spent a lot of their time moving in and out of the stock market, right? So let's see if I can find this thing for you guys here. Let's see if I can find it. All right. Oh, there it is right there. So you see this right here? Let's go ahead and zoom in on this right here. So this is your probability of a loss in the stock market over certain time periods. Okay? This is your probability of a loss in the stock market over certain time periods. So again, here's how a lot of people work, right? They're in and out of the stock market all the time. Guess what? If you bought the stock market for one day and sold it, you got a 46% chance of losing money. If you bought the stock market and sold it in 1 month, you have a 38% chance of losing money. Okay? You move that down to 1 year, you only got a 25% chance of losing money. So there's a 75% chance you make money if you hold the stock market for 1 year. Okay? 75% chance. You move that down to 10 years or 5 years, there's a 10 to 6 to 10% chance, right, of losing money. So the chances of losing money drop significantly the longer you hold the stock market. Okay? And then when we go to 20-year period, there's no stat for that because now I'm sure that they're gonna have a percentage chance of losing money, but the reality is that there's no historical evidence of anybody losing money over 20 years. Like, so you hold the stock market for 20 years. I can't go to a chart and show you where 20 years later we were losing money. I can't find that anywhere. Okay? Just a little side note there. Okay? So let's talk about the opportunity cost now. So now that you know the stock market traditionally delivers a positive return, that means everything you invest in, the stock market is what you call an opportunity cost against that. All right. Now, over the past 20 years, it's an average of 10% return. Over the past 10, right, 5 to 10 years, you got an average of about, 12 to 15%. We're gonna put it at we're gonna put it at 13 and a half, right? So we're gonna say that your opportunity cost right now is 13.5%. Okay? Your opportunity cost is 13.5%. So anything you invest in right now, you're giving up 13.5%. That's going to be your assumption. That you're giving up 13.5% to get that. Okay? Now then you have to consider consider inflation, right? Let's go back over here really quickly. Where's it at? Right here. All right? The impact of inflation on that money that you're going to get. Right? So they call that a payback period, right? So look, let's go inflation. We're going to assume the Fed gets it under control and, over most of your time, you're going to incur 2% inflation, right? And please don't hit me with the conspiracy theories. Well, inflation's, usually like 85%. If don't, no conspiracy theories tonight, please. All right. We're going with a base 2% inflation. This is just, we're just assuming over the long run, the Fed gets it under control and it comes back down below 2%. And then we can go from there. Then we have what's known as the risk premium. Now, this part is really interesting here because, the situation with the risk premium is pretty interesting because over time it changes, it shifts. I'm gonna show you what the bank does here, right? Let's talk about what the bank does, right? Have you guys ever heard of the prime rate? Right? Put it in the chat on Twitch. Have you ever heard of the prime rate? Okay, yes. Okay, you guys have heard of the prime rate. Good, good, good. Question in the chat is what's the difference between using the mean or the average? So the median, right? The difference between using the median and the average when you're using the price targets is that the average tends to just give you that price that's right, like smack the average of the high and the low, right? Whereas the median is really giving you the true middle price, right? If I listed a bunch of numbers on a paper, right, from lowest to highest, there's going to be a true price in the middle. So let's say, for example, I listed those numbers and I listed 9 numbers, right? The number 5 is going to be the true median. It's not going to be the average. Okay? So a lot of people prefer to use the median as the true middle as opposed to the average, which just gives you the, sort of the 50% mark between the high and the low. Okay, so that's going to be the difference. So it's up to you when you decide to do that, which one you prefer, right? So the prime rate, for those that don't know what the prime rate is, right? Let's see here. Right. So in the U.S. bank prime rate is 6.75%. This rate acts as a benchmark for consumer loans, right? Like credit cards and HELOCs, right? And it is calculated by adding roughly 3% to the Federal Reserve's target Fed funds rate. Okay, now notice they said they add roughly 3%. So that is what is it? It is a premium. It is a premium on top of what you would already been charged, right? So today I'm going to have you guys use this premium. All right, I'm going to have you use 3%. We're going to keep it really simple. All right, we're going to have you use just the normal premium that a bank uses on a loan, right? Now I'm going to add one more thing here. And, you know, it says risk premium, right? We have the premium, we haven't accounted for the risk yet, have we? All right. So in this event, we're going to use what we call the beta. Okay. And the beta, we can find that on stock analysis and go right to the overview tab. You'll see the beta right here is 1.16. Okay. Beta is 1.16. Okay. Now, when it's all said and done, we are going to use either the risk premium or the beta. We're not going to use both. Okay? I repeat, we're going to use either the risk premium or the beta, but we're not going to use both. That's going to be up to you what you end up using. But what we're going to do is we're going to calculate two different discount rates. We have discount rate 1, discount rate 2. We're going to use the average, okay? So what we want to do is we want to add up these elements here. You have the opportunity cost of 13.5% plus that inflation rate of 2%. That gives you 15%, right? Plus that risk premium. So your discount rate, your first discount rate is going to be about 18.5%. Okay, that's going to be your first discount rate. It's going to be about 18.5%. All right. Now, discount rate number 2 is going to be the opportunity cost. Oh, wait, hold on. 1 second here. Let's put that in brackets. So it's going to be the opportunity cost plus the inflation rate. And we're going to multiply that by your beta. So the beta is going to account for the risk in this particular scenario. Okay, we're going to have the beta account for the risk in this particular scenario. That's going to be about 17.98%. So your average discount rate is going to be probably around 18%, or somewhere around there. Your average 18.24%. So this is what we're going to use as our discount rate. All right. Now, the time value of money. All right. The time value of money is very, very simple. The hard part is done. We figured out and by the way, these numbers can be consistent. You don't have to change these numbers. These numbers are consistent the entire time. Okay. You can decide if you want a premium or no premium, for example. So then your discount rate would be more like 15.5%. All right. You can decide on that. All right. Warren Buffett, pretty much famously said that, hey, you're not always going to get that discount that you're looking for. Right. These are Warren Buffett's words. You're not always going to get that discount you're looking for. It's not going to happen. Right. Sometimes you're going to sometimes you're going to be able to get just the right price for a stock sometimes. Okay, that's basically what he's saying to you. And it won't always be a margin of safety on that. All right. So the time value of money, let's talk about that now. All right. So they say this stock is worth $156.34 on average. All right. That's what they say. They say this stock is worth $156.34 on average. Keeping it really simple here, right? We always have to discount what they say the stock is worth. We always have to discount that. So for those that don't know, we're talking about Airbnb, right? We're talking about right, so stock we're talking about is Airbnb. All right, that's the company we're talking about. All right. They say it's worth $156.34. Well, they say that's worth that 1 year from now. So this is a 1 year forecast. Right? That is a 1 year forecast that you're looking at. How the time value of money works is if I told you I was going to give you, let's say this is today, right? Let's say this is tomorrow. Let's keep it simple for now. This is today, this is tomorrow, right? Let's say I asked you to borrow, we're gonna keep it, a friendly family style conversation, right? Let's say I asked you to borrow $20, right? I said, yo, I need to borrow $20. I gotta put some gas in my car. I got a job interview tomorrow. But I also got some money coming in. I give it right back to you. Okay. Now, if today that dollar that's worth $20, that's what it's worth today. It's worth $20 today. Okay. Now, what we have is what we call, all these things at the top: opportunity costs, inflation, right? What's the risk that he will pay me back or he won't pay me back, right? That kind of stuff, right? But let's just consider opportunity costs and inflation. Those are the two most important ones. Okay? Opportunity costs and inflation. Those are the two most important ones. So let's say you let's say you had a chance to buy a what let's see here. Let's just say you had a chance to buy let's say you had an arbitrage opportunity. What arbitrage is I can buy something right now that's already worth more, right? It's already worth more, but somebody else is selling it for less. So let's say for that $20, somebody was selling a watch, right? They were selling a watch for $20, okay? But somebody already wanted to buy that watch for $25, and they wanted to buy it tomorrow. So, what is your $20 worth? It's worth $25, right? If you're on Twitch, let me know if you understood that. I'm gonna say it again. Say it again, right? Always discount the forecast, April. That's correct. I'm gonna say it again. So let me know if you're on Twitch. Let me know if you're understanding this, right? So I say to you, let me borrow $20. I'll pay you back tomorrow. I get some money tomorrow. I'm gonna pay you back. All right. Now let's say that if you were to keep that $20, you could buy a watch right now for 20 that somebody already wants to buy for 25. Okay? I need y'all active in the chat because this is a difficult session. I need to make sure everybody's understanding me, man. Let me know if you understand me over there. All right. So somebody already wants to buy the watch for 25. You can buy it today for 20 and sell it tomorrow for 25. So if I'm borrowing $20 from you, right? If I'm borrowing $20 from you today and I'm giving you $20 tomorrow, there's a problem there. There's a problem there. The problem is that $20 I'm giving you is really only worth, right, $15. Right? Why? Because I have to subtract the $5 that I could, like, so you have to subtract the $5 that you could have made on that $20. Okay? So I'm paying you back with money that's worth less. That's how this thing goes. If I said I wanted to borrow $1,000, right? Let's go out in time now. Want to borrow $1,000 from you today, right? And I was pay you back in a year. Okay? Then the same thing applies. Same thing applies here, right? That $1,000 has an inflation cost on it of 2%, right? What's 2% of $1,000? All right, that's $20, right? So I'm sorry, $40. I'm sorry, $20, right? So now, here's the deal. So now, really, that $1,000 is really worth $980 in a year. Okay. Now that may be nothing to you. Like, keep the $20. It is what it is, right? But in investing, we don't just say keep the $20. It is what it is. Okay. Now, the time value of money involves actual, so the difference here is going to involve a a division aspect instead of just subtracting 2%, right? But I'm just going to, keep it simple tonight, right? And we're just going to use the subtracting factor here. All right. So from the time value of money, all right, there now you what you do is you go backwards. You go backwards. Okay. So now it's not $1,000 today, it's $156.34 1 year from now. That's what they're promising you. Okay? But I know for a fact over that 1 year on average, I can get at least 13.5% from the S&P 500. So let's start with that. All right? Equals this. All right? You go times 1 minus this number right here. Okay? So I know for a fact, right? I know for a fact that if I pay more than $135, I'm losing out on that opportunity cost. Right? There's a greater chance that I lose out on that opportunity cost. There's a greater chance that I don't beat the market in that regard. Okay? Now watch this. So you kind of go like this. So equals 1 minus, right, this. So we know that this forecast is only worth about 86.5% of what they say it's worth. Watch what I do here. All right. Equals 1 minus 13.5% plus the inflation. All right. And what do I get? If I factor in the inflation, it's only worth 84.5% of what they say it's worth. Are y'all getting this math? All right. 1 minus whatever the opportunity cost is. All right. Whatever I'm risking, right? If I put 2% in, if I put my money in this stock at $156.34, and 1 year from now, the stock price is still at $156.34, chances is I lost at least 2%. Does that make sense to everybody? All right. I repeat. All right. If I buy the stock at $156.34, and a year from now, it is still worth $156.34, the chances are I just lost 2% of my money and nothing had to happen. Okay? Now, then on top of that, if the market really gave us that 13.5% it's been giving us, I lost out on that too. So that's what we're getting at. And that's why I said, the least you want is these two here. So the least you can do is multiply that by 0.845. All right. So what you would do, all right, let's turn these into numbers instead of percentages. That's 0.845 or 0.85. You can say 0.85 if you want to. Okay. Let's call it 0.85. All right. So, actually, no, I want my extra decimal. I need my extra cake. All right. If I round it up, I'm getting less from them. I want every penny of it. I'm like that. I'm like that. All right. So then you keep it really simple, and you would say that 1 year forecast times 0.845, $132, and let's call it 11 cents. Okay, $132.11. All right. If I buy it for less than this, I'm sorry, for more than this, I meant to say, there's a chance that I'm going to miss out on some gains. Okay? And you can do the same thing over here. So, all right, equals 1 minus this. So what I'm doing there, that's 81.5% equals 1 minus this. That's 82.02%. On average, I need about an 81.76% discount. That's what I need on average. Okay? So we're using averages today. We're going to go with the average. So $127.82. Okay? That's what I need for Airbnb. Let's go over here to check the price on Airbnb. The price is $129.10. Isn't this interesting, though? Isn't this interesting? Airbnb, today, if you do the math, they're at $131.35. Okay? They're at $131.35. All right? One of our discounts here was what? 132.11. Okay? So they came into today discounted just about enough to start giving us a discount. And then right now they're giving us even more of a discount, but it's not quite the discount we want. Okay? All right. Let's go ahead now. Let me pause here and give everybody an opportunity to ask questions. We're going to be doing more stocks, but this is the point where I pause and give room for questions. Let's talk about it. What questions y'all got? And this is also that point where I'm gonna start finding out who's paying attention. I've never done one of these sessions and not done that. This one is too important. All right. Shout out to everybody that's on the Twitch stream right now. I appreciate y'all for swinging through. We 26 viewers strong. That's dope. All right. Anybody have any questions?
Well, I just got in the building about 15 minutes ago, so I just been kind of following what you guys are been talking about thus far. So I don't know what I missed.
It's all good. I think Justin had a question, so let's see what his question is, and maybe it'll bring you back around, with some other questions. All right.
I was just gonna say, can you put the original formula back up?
Yes. Yes. Got you. This is the original formula right here, guys. All right. That's your original formula right there. Now, but again, I took you guys a different route today, right? You understand? But what you would do when it says 1 plus R, right? So it's your the fair value or the future value, which we know the future value is what? The average analyst target, right? Or the average analyst forecast. That's the future value. That's what they're promising us 1 year from now. So that goes over top. You divide that by 1 plus R. R would be the expected return or the discount rate. Okay, so that's 18.24% right here. These are your discount rates. All right, you got that, Justin?
Gotcha. So it's present value, equal future value, or analyst forecast divided by 1 plus discount rate.
Yes, sir. That's it.
Gotcha.
All right. So I took you guys this route today because in the past, Justin, that's been difficult for some people to pick up, and the numbers aren't that different. You know what I mean? So I'll do it right here. So equals this right here, your forecast divided by 1 plus. All right. So you see, you got that 132 pretty much right there. See that? See, right around that same number that we were discussing. So again, so if y'all just heard that, you would go 1 plus 18%. So it'd be divided by 1.1824, pretty much. All right. Really, all you have to do is turn this into a decimal instead of turn this into a decimal instead of a percentage, and you're good to go. All right. That's all you got to do. All right. Remove these from here. All right. So this would be your range right here, pretty much. Would this actually apply to the SPY as well as just equities, risen SPYs approximately 20-31% from COVID crash? We're not talking about prices over that period. We're talking about, right, what is it worth next year? We have discount models to analyze what the SP 500 is worth, right? We have those models, Celeste, but again, we're right now we're focused on individual equities and building out a portfolio that can actually beat that S&P 500, right? But the best way to beat the S&P 500 is to not overpay for stocks. That's the best way to beat it. I can't tell you anything different than that. Okay? I can't tell you anything different than that. The best way to beat the market is to not overpay for stocks. You find yourself overpaying for stocks on a regular basis, you're going to find yourself on the wrong end of the opportunity cost. All right? So any questions before we do another example?
Yeah, I have one.
Yes.
So why isn't the 127.82 discounted enough? You said 132.22 is the discounted rate number, and Airbnb is currently at 127.82. But you said it's not discounted enough.
No. 127.82 that's a discount. That's us discounting it, right? 156.34 is not discounted enough. That's the number there, right?
Yes, I do see that, but the 132.22.
Yeah. That's the one that's calculated from the actual time value of money formula.
Yes, can't do that.
Right? then this one is more just actually discounting. Like, so I'm taking the percentage and I'm basically subtracting it from the forecast, right? So both of those are a discount. So that's two ways of discounting it. You can see you'll come up with slightly different numbers here.
Yeah, I think current price is 129.
Yeah, the current price is 129, D'Amico. Yeah, current price is 129. So they're like just below that price. Root of the forecast is actually the average analyst target. So we're using the analyst forecast that already exists. But what we're doing is we're making sure that we don't pay that price, right? We're not going to pay the price that they give us. We're going to discount that. All right. So I'm showing a simple modeling right now. We're doing simple modeling. No problem. D'Amico, did you understand that?
Yeah, that price was the was it 120?
129.
Going to my notes, 129.
Yeah.
But with that average price, 156.34, right?
No, that's the average. No, that's the average forecast.
That's right.
All right. So all right, let's talk about the difference now. So the current price is where the stock is trading right now. The forecast is where everybody. Let's just say, think about it like this: where everybody on Wall Street is telling you it's going, or what everybody on Wall Street is telling you the stock is actually worth. Okay. So it's like saying, imagine I'm a salesman, right? I show up to your door. I want to sell you a vacuum cleaner, right? In this particular case, vacuum cleaner is the stock. I tell you, I want to sell you this vacuum cleaner for $156.34. Okay? Now, let's imagine in this particular case, I don't want you to plug this vacuum cleaner up right now, right? Like, I'm just trying to sell it to you without showing you that it actually works. That's your risk, right? Your risk is that it doesn't work at all, right? You with me on this?
Yes, I am.
Right. The risk is that it doesn't work at all. So, would you give me the full amount that I'm asking for the vacuum cleaner, yes or no?
No, you said always discount what they say
Right.
it's worth.
Right. So, the same way I'm saying you're not sure this vacuum cleaner works, you're not sure these average analysts, the average analyst isn't just extremely bullish on Airbnb. Right? Like that could be their favorite stock and their favorite company. For all y'all know. Right? That's how you think about this.
Got it.
All right. So the risk that we're taking is that I'm going to buy Airbnb because this guy says it's worth 156. When these guys say it's worth 156, Wall Street says it's worth 156. And I'm going to miss out on the 13.5% of the stock market. And then, mind you, if I paid 156, right? Let's say I did pay 156 for the stock. It's at 129 today. That's 21% below what they say it's worth. So that should already tell you right there that you could have, like most of the times you can get it at a better price. Right? Matter of fact, let's do this all over again. Now, you're not going to be able to get it at a better price every time. But a lot of times you will be able to. Okay? So, let's do Kinross Gold, KGC. All right, I'm doing Kinross Gold because this should be a less volatile name. Should be a less volatile name. Actually, oh no, wait, hold on. It's actually more volatile. I forgot. Gold has been up and booming. So hold on. Kinross is actually more volatile, 1.35. Okay, so beta is 1.35. So right out the gate, they're saying I got it discounted by, on average, 19.7%. Let's get the average. Let's get the forecast now. Watch this. Let's hit the forecast. All right, $40.91. $40.91. All right, so it says here. All right, hold on one second here. One second here. There we go. So this is your range here of like you want it somewhere between 32.85 and 34, 32.85 and 34.17. All right. What was the current price? It's trading at like 20 something bucks, right? Where was it at? 23.66. All right. So right now, we would consider this to be a huge discount. But one of the things you got to think about is, well, why would it be so discounted? Now you got to ask yourself that question. Why would it be so discounted? And that's where you realize it's a commodity stock. All right. It's a gold name. So commodities are like the most volatile thing on the planet. So, you could, in this particular case, if you wanted to, you could discount it by multiple years if you wanted to. So that's where you would say, let's say to the second power, and I get $28.55. Okay. So when I'm dealing with something that's a little more volatile, I can always do that. I can always discount it multiple times to find out what kind of a discount am I actually getting right now. So I'm discounted by 2 years. So that means I can look forward to 2028 from here instead of 2027 and ask myself, this is what I need to ask myself now. Do I believe it's going to be above $28.55 by 2028? If I ask you guys that question, what would your answer be? Do you believe that gold is going to be trending to the downside all from now all the way through 2028? Or do you guys believe the downside and gold is almost over? What's your answer to that question? All right. So you see how that works now? So I can discount. And by the way, when you do the math on that, for those that are doing this for the first time, all you have to do is discount it again. So you go 1 plus 1.971, and you do that math first. And then you take your result, and you divide it by 1.971 again. And it will give you the number right here. It give you this number. Try it. Try it. All right? Give you a second. Try it. So take this number right here, 3417, and divide that by 1.1971, and you should get, all right, 28.55. Yes, everybody got that? So you just discount it twice. And that means you discounted it by 2 years. That's what that means. All right. So this is just me figuring out, well, if I'm paying, what price am I paying today and how much am I discounted by? So now I'm discounted by 2 years. Kinross Gold is. And I got to ask myself, okay, cool. I know why it's discounted so much because gold prices have come down considerably, right? Now the question becomes, well, am I discounted enough through 2028? Or do I need to discount this thing through 2029? Right? Now, you're not going to have to ask yourself this question for every single stock. Okay? So just be clear about that. You're looking at the ones that are showing what look to be deep value. All right. Well, looks like okay. That's now that price is just it's 72% below the average analyst target. Okay. What's the 5-year return? 204%. And that's how I look at this. So you know what? I I would tend to believe that there could be some more downside here, right? But this is a reasonable price, and I can probably get it a little bit lower as well. So let's say I discounted it by 3 years. All right, let's say I did that. That's $23.85. Okay. Um, now, did you guys notice that the lowest price target for them was $10? Did y'all notice that? The lowest price target for them was $10. $10. I'm just curious. I'm going to check something real quick. So the average business cycle is 5 years. $16.64. And I can be probably more than certain that if I can get it at this price over that business cycle, I'm sure I can get a return there, you know? So little things like that. Um, just kind of looking at what's the price tag, what's the expected return, those types of things, you know? So, you know, that's that. Um, VRT. Let's do VRT real quick. All right. Now, who's going to help me out? Where do I get my forecast from? D'Amico, where's my forecast come from? Where do I go to get my forecast?
Sorry, get back over here. I was still over on Twitch.
Okay.
Hold on. Hold on. A moment. So you asked me where did you get it from?
No, where are we supposed to get it from? Like, so where do we go to get it? Now I'm double checking to make sure we understand the process, right? And we know where to get things from. So where did I go to get my forecast from? What's the website?
Don't know. I think it's what analysis, stock analysis.
Stockanalysis.com. Okay, so you got to, all right, so remember that one. So let's go over there real quick. Let's type in VRT. All right. Now, what do I need? I need the average forecast. I go to the forecast tab. All right. I go to the forecast tab. I got my average target right here, 378.31. Okay. So I'm sorry, let me grab that. 378.31. Okay. All right. Now, okay. So Justin, help me out here, man. Where does my opportunity cost come from?
Section.
And by the way, guys, it's all right if you can't answer these questions the first time. It's okay. You know, it's a learning process. Okay, it's a learning process. All right, but where, like, what creates the opportunity cost of investing in a stock? All right, I'm going to repeat it. I'm going to say it. I'm going to say it now, and then I'm going to come back around. And come back around. All right. What creates the opportunity cost of investing in a stock? And by the way, April, great job, April. April did have it right. She said stock analysis. Okay. What creates? No. I'm talking about on Twitch. But yeah, great. Well, we already know you knew the answer. Um, so what creates the opportunity cost of investing in a stock? Right. So great job as well, Shay. Great job. Um, what creates the opportunity cost of investing in a stock is that we are passing up on investing in the S&P 500 to invest in a stock. Okay? That creates the opportunity cost. Justin, did you get that? Okay? Because the number one option that you have is that you can just invest in the stock market. And if you held it for 20 years, nobody's ever lost money. But I can guarantee you guys, I can find a stock right now that's been losing money for 20 years. You gotta understand that. Make no mistake, it's out there somewhere. There is a stock in this world that's been losing money for 20 years.
And they should be kicked off the exchange.
Debatable. We just won't invest in it. All right? We keep our money somewhere else. And obviously that's the other opportunity cost, is that you could always invest in another stock that's doing better, right? So I'm going to break this down for you guys like this. The only way to know if you got a better investment is if you did better given the same risk, right? Or you got the same given less risk. So if I take less risk in investing in the SP 500 and I got at least 13.5%, I did better than the SP 500. Okay?
So you say it again?
So the only way to know you did better, listen to this very closely, guys, is if you took the same risk and got a better return, or if you took less risk and got the same. Okay? So if I invested in, let's say, Coca-Cola, and I got the same return as the SP 500, I did better. Because I took less risk investing in Coca-Cola.
And then for 13%, that was what you would expect to gain on average of the S&P over 1 year?
Over the past 5 years, on average.
Oh, 5 years, okay.
But yes, no. I'm saying that's the average 1 year return over the past 5 years. So yes, you're expecting it over 1 year, but that's the average over that time period. Because there's been some years where we've gotten 20+% out of the SP 500. Okay, it's averaged 13.5. Now, the other way here is if I was to take the same risk, investing in the SP 500, right, and I got a better return. So I invested in a stock that was a beta of 1, for example. I invested in a stock that's a beta of 1, exactly 1, and I get a better return, then I know I did better. If I take more risk and I get a better return, that's pretty obvious, isn't it? See how that works? There's no way to tell if you did better unless you do another measure, which is the trainer measure. A total different story. All right? That's a proportionate style. We're saying the only way that you absolutely positively know you did better without having to do any other calculations. Okay? All right. Now, the next stock we're going to do is VRT, like we said. Let's get the beta for VRT now. And I get the beta from where? From stock analysis. Okay, the beta comes from stock analysis. Let's go to the overview tab. My beta right here is 2.04. That's even more, right? So I'm taking even more risk investing in VRT, right? Big risk. Was that again? 2.04. So what is beta? Let's talk about beta. Beta is the amount of risk I'm taking either above or below the market. Okay? So a beta of 2 is essentially saying I'm taking twice the risk of the SP 500. The SP 500 is a beta 1. It's a beta 1. Okay? So anything that has a beta 1 moves exactly like the S&P 500, up and down. A beta of less than 1, they move less than the S&P 500 up and down. A beta of more than 1, they move more than the S&P 500 up and down. Shay, question?
What's the beta on the Qs?
It's like a 1.4 or something like that. I can't remember.
Okay.
I'm gonna check right now though. It's a quick check, so I'll check it real quick. 1.23 actually.
I'm surprised. I would have thought it was more. I thought it was that.
Sometimes it is. Beta changes. I remember a point where it was a 1.4. That was around the time when Tesla was running wild. It's not been that for a while. All right.
The average actually here 10 and a half, 12. That was the average. So I guess we went up a little bit on the average because we had some spring negotiation years. I guess, right?
Yeah, we had some really big years, so it drove the average average return to the upside by a decent amount. Plus, you got to consider we had but in the past 10 years we only had what 2 negative years, I believe.
Nice.
Right. Yeah, it's 2. Yeah, 2 years. Right. So okay. Now opportunity costs, that's actually for a conservative investor, April, is actually the opposite. If your opportunity cost is higher, then that makes it more conservative, right? If I had an opportunity cost of, let's say, I don't know, I took the real return of the SP 500, the real return, let's say that's like, I don't know, 10%, 9%. We're talking minus inflation, right? Then I'm being aggressive, right? By taking the inflation out of the the return, right? Leave the inflation in and being more conservative. Okay, so keep that in mind. Anytime my discount rate is higher, I'm being more conservative. Anytime it's lower, I'm being more aggressive. All right. So it says here we have to discount this stock by an average 25%. That makes a lot of sense. I mean, it's 2 times as volatile as the S&P 500. Y'all let me know. Does that not make sense to discount it by at least 25%? That sounds like it makes sense to me. Right? And shoot, I mean, there's that 31.6% right here that could, but we're going to take the average. We're going to take the average. 25.06. And now you can see why we have the average here. All right? So anywhere from 283.51 to 302.50. Okay? Where are they trading at today? Look at this. They dropped. Y'all seeing this now? This has been happening consistently here now throughout the night, where you can see these stocks dropping by a certain amount. That's really consistent with showing they were overvalued, right? This means this stock came into the day trading at like about $290. All right, well, let's call it $289.40. All right. And so it says here that 283.51 was the low end of our target here. Okay. So, well, keeping all things fair here, that suggests that and then look at this. All right. 378 is what we get a year from now. Now it makes a lot more sense. So if you want to buy some VRT, well, they just served you a little bit of a discount today. All right. Anisha, I believe that was one of your stocks, right? Well, they throwing discounts. They are throwing discounts. Okay. Let's do 2 more names. Let's do 2 more names here. I'm interested in NetEase. Let's look at NetEase real quick. Okay. NetEase. Let's try this again now. Justin, where does my opportunity cost come from? Let's try this again.
Not investing in SP 500.
Not investing in the SP 500. Look at you. See that? Just like that, right? Booyah. All right. All right. Let's see. Price target is 168.28. Just copy that and bring it over.
My only one question, that's always going to be 1350. Like, that's just like the number we going with, or that number change?
It's going to change, but you don't have to change it every 10 seconds. Right? You know, like this is the first time I've looked that number up in 3 to 5 years. All right, that's probably well, more like 3 years. I looked it up pretty, consistently. So let's say the first time I looked it up since like 2024, pretty much.
Gotcha.
All right. You know, and I like to look at those average returns there. All right. And let me rephrase that. The first time I've looked it up in order to actually implement it into this, particular element here. Okay. The beta is a 0.8. So now we have a stock that's less volatile than the market. Watch what happens here, guys. 0.8. So now in this particular case, what happens? In this particular case, the fact that we have the risk premium here now bumps the discount rate up here. Now it's back to 15.45. So now you can see why it's good to have a conservative rate and an aggressive rate. Now you guys are starting to see why? Makes sense now, doesn't it? Because when one is being a little too conservative, the other will push it back to the upside. When one's being a little too aggressive, the other will bring it back to the downside. So instead of discounting by 31% on that last company, right? We ended up, doing only 25%. Christopher?
Yeah, where did you get that discount rate from?
The second one? The second one takes into account the opportunity cost and the beta. So you just take the opportunity cost plus inflation and then multiply it by the beta. Fan, we are here to learn. All right. So if you didn't want to learn, there are plenty of places you can be tonight. All right. But we're here to learn. So we don't just randomly ask Google what a stock is worth. All right. We learn how to do it ourselves. All right. And I can assure you we've been very successful doing so. All right. So it's up to you whether or not you want to, kick back and learn some things. Well, no, I'm not missing your point. I got your point. I need you to get my point that this is a class, so I'm teaching them something. All right. So, that's the whole point of this. We're not here to get your point. We're here to learn. All right. All righty. Now, has anybody developed any questions that that they want to ask now that we've gone through a few more companies? Anyone?
Was that you're asking if anyone has any more companies that we want to do?
No. I said any more questions. Did you develop any more questions? I'm saying since the last time.
Uh,
Well, since you want to do another company, how about you walk us through one? Come on. Help us out.
all right, well, let me see. I'm gonna go. We go. We're going to top five of them. Let's go. Protalix, PLX, right?
PLX, okay.
All right, so I'm gonna go to stock analysis. Right?
So stock analysis. I'm walking with you. Don't be looking at my screen, man. Don't look at the screen. PLX. All right, we got PLX. Okay.
Okay, boom. So now take over beta as 0.01. So right at the 01. Um, let's see, forecast. Uh, I just testing this thing.
So from looking at this, right? A beta of 0.01. That's going to automatically suggest that there's there's a certain something about this particular stock you're going to need a discount, right? A lot more. So remember we talked earlier where we said, hey, when you look at certain stocks, it's more likely that you're going to have to discount it by multiple years, right? So 0.01 suggests this stock ain't moving at all, right? That's what it suggests. The market's moving and the stock is not. Right? So then you have to consider that you're going to probably have to. Go ahead. Say that again.
No, I guess I found myself like scared of this one, like seeing this slowing down.
Oh, no. There's nothing wrong with that. No, what we're saying is, right? Now we have to say to ourselves, now I discount it, right? I bring it down. So let's say I discount it by multiple years to try to figure out over what period of time can I expect them to be above this current price, right? That they're currently at. Like when will they actually start moving? And what's reasonable? All right, so let's start. You keep going. Keep doing your thing. I'm listening to you. I was talking with you while you're doing it.
I must be bugging. I'm actually just for this. I don't see the forecast. I see every financial statistics history profile chart. So
If you look at the first page, you'll see it says price target $11. Look at the very first page. See it, price target $11. Now this could be one analyst for all you know, right? Matter of fact, let me see. They usually, yep. Let me see. Analyst one analyst. So you got to look at that stuff too. Yeah, everybody just heard that, right? So this is just one analyst telling us his opinion on the stock. So there's no consensus, which means you've taken what? A greater risk, right?
Right. But then I was things with that would even further entice us to follow our formula to score ourselves.
Exactly. That's exactly what I'm getting at, right? So if we discount it by 1 year, what is it worth? Well, you're putting together everything right now, right? I'm waiting for you to finish that. Because your discount rate is going to be brought down tremendously because of a suggestion that the company is not too volatile. It doesn't move. So it's probably been stuck in this price range for a very long time. You know, But so for those that are looking at my screen, I'm gonna start to show you what this looks like. Justin, don't be looking. I'm gonna start to show you what this looks like when I start to discount it by different years. I discount it by 2 years. This is what I need right here. All right, a 2-year discount. This is what I'm gonna be needing. All right. Let's say discount it by 3 years. All right. Let's just go all the way. Let's just take it all the way to 5. Okay. And I got to ask myself, between now and 5 years from now, is this what I'm expecting? Now, this could be what Justin's expecting. Let's do the math on this percentage here. All right. What was it? What was that stock price again? $1.97. Okay. Equals this divided by $1.97. All right. So this is what we're talking about right here. Okay, hold on 1 second, actually. Let's over here. So this is your percentage return over that 5-year period, guys. Oh, sorry. That's your percentage return over that 5-year period. All right. That's what he'd be looking like right there. All right. So exactly, fan. Exactly. That is correct. All right. It may not come up to exactly 30%, but that's the idea. Right? If it moves 3 times as much as the market, it has a beta of 3. All right. I appreciate you for rocking with us, man. Much appreciated. So look, check this out, right? So this would be his expected return if he's looking at it from this perspective, right? Now, obviously, it's going to be greater than that because the stock's actually trading below this price that I have right here. Obviously. All right. Now, let's go one full business cycle. So a business cycle is actually 7 years, right? So this is what it looks like over a 7-year period. Okay. So is the stock going to go from that $1.97 to at least this much over that 7-year period? That's a decent return. That's how you basically look at this, guys. Right? So whenever I see a stock that's deeply discounted, now I'm having to figure out what do those returns look like. I have to start looking further out in time because whenever a stock is trading this much below the analyst target, it suggests that there are great risks with investing in the stock, and it suggests that there are a lot of uncertainty surrounding the company, and we may lack the ability to forecast the immediate future, but there may be positive things down the line. And that's why the forecast is still above the current price. You don't know when that's going to turn around, but you at least have your you don't know what's going to turn around, but you at least have your forecast for the future here. So Justin, what do you got, man?
So, this so these trading value. It's the place where this says 1.5 right? These analysts forecast social intellect right over was it 1 plus? I didn't get the discount yet.
So wait, let me be clear about something real quick. The present value is not the current price. Those are not the same thing. So the present value is unknown. So just put PV. Don't put the current price.
Okay.
All right. So we just put PV equals the analyst forecast. That's $11. All right. Divided by 1 plus whatever your discount rate is.
And so I got to I'm sorry, so I don't know what to
So let me start you.
inflation what my time my multiplying all that times the
No, let me start you off here, right? Let me start you off here. You have a base rate that you're going to start with.
okay.
The base rate is always going to be the opportunity cost plus inflation.
So 1350 plus 2%.
Yeah. Add those two together.
So 15 and let's say 16%.
Okay. If you want to round it up, that's fine, right? Okay. So that's always going to be a base rate. You just always start with that.
Okay.
So you would always just start with 16% and then work from there. Right? Now, remember what we said, that opportunity cost could change. It can go up, it can come down. So a lot of times it's going to come down. Let's say it comes down to 10%, then your base rate is going to be 12%. You see that? See how that works?
One time.
No, that base rate can go up or come down if your opportunity cost changes.
Okay.
Right? So, you know, the reality is the S&P 500 is going to have varying returns over these different periods. So it can come back down to 10%. Your base rate ends up being 12. Right? If the average return of the S&P 500 went to 15, your base rate is 17%. Okay? All right. Now, then you take your base rate and you have two different paths here. Path A is to just add the risk premium of 3%. So it gives you 19, right? Path B is to multiply that that opportunity cost. I'm sorry, your base rate I meant to say by the beta, which pretty much makes your beta like next to nothing in this particular case, right? Because I'm not your beta, your discount rate next to nothing because you're talking about 1% of the opportunity cost or the base rate. Okay, so you take the average of 19 and 1, that gives you about 10. So it means you should be discounting this stock by 10% per year. Make sense? So go ahead, put your work in. What you got? So this is what he should get for his first year. Right here, guys. That's what he should get for his first year right here. So the present value equals, right, what? Thanks, April, for putting that stuff in the chat for me.
I'm still jumping. So I just make sure I got this right. PV equals over 1 plus 0.16 or 16%.
No. Remember, you had to do the average, right?
Where do I find the average again?
No, remember you had two discount rates. One was the 19% because that was your 16% base rate plus a 3% risk premium. Then you had your base rate times that beta. The beta is only 0.1%. That's 1% of 16. So that's about 1.6. So you have, see what I'm saying? 19.
Yeah, I'm still missing something. Where's the base rate at? Like, how did I get that?
Remember, opportunity cost
Opportunity cost at 13 plus 6
plus inflation.
3% discount.
Say that again?
The base rate will be the 16% discount.
Yes.
Yes. Actually, but okay.
Right. So when I say base, what I mean is you're always going to start with that.
Okay, so there we go. Let me see with that.
Right.
Well, should I do that? See, so yeah, 1.76. So we should.
Thanks, fan. Much appreciated.
Did you say 1% of 16 or 10%?
1% of 16. Because again, the beta is only 0.01.
0.16?
Point zero, no, point zero, so it's 0.0016.
Correct. So that would be and risk if not the same. The other option would
So you have to divide. You're pretty much dividing 20 by 2, which is 10. That's what I'm trying to tell you.
okay.
Right. Because you're going to take the average and use that as your discount rate.
So I'm looking at somewhere like around $19, like basically like $19 and change somewhere if I'm just eyeballing it. Because
Mm-mm. Mm-mm. You have 11% divided by 1 plus your discount rate. What's your discount rate now? It's 10, right? 10%.
so but it's 1 plus discount.
Yes.
Right.
So the discount is 10%, then it's 0.1. So it's 1.1.
So you have economic challenge. 12 that's what it's sorry.
Yeah, 11 divided by what? 1.1, right? What do you get?
1.1
It's 10. So the issue here is that we are well below $10,
Mm-hmm.
right? Which suggests we're taking a huge risk because who gives something away for free?
Right.
There's got to be a risk here somewhere, right? That's what the market is telling you. Whenever the market puts something well below a discounted price, they're telling you they believe it's risky. That's exactly what they're saying to you. The market speaks to you through prices. That means like that's literally the market's language. Does everybody understand that? That's the market's language. When they refuse to give you a discount, what they're saying to you is this is too good to give you at a discount. So when you find it at a discount, finally, you know you got something. When I look at a stock and 99.9999999% of the time I can never get it at a discount, I know the minute I do, I found something good. All right. Or the stock just went to trash. Right. But, most of the time you found something good. But when the market is consistently giving you a discount on a stock, you're taking a risk. So what you do? So Justin, you do that math again. You go 10 divided by 1.1. And then that gives you what the stock is worth 2 years from now. So what I did was I did 7 years. Let's fast forward here. I did 7 years. All right. Now you can look at my screen. Let me show you something here. I did 7 years. But I got $5.64. Which says that over time.
But even with like say that.
No, I didn't say anything. Keep going.
No, so would it stop like let's say like would it be as low as this, right? Or let's say I don't say just any penny stock, but let's say the stock is low as this, like with this count, like even really be I don't know if that's the word for it, but
it's always warranted, right? Because what if I discounted this, right, by let's say you plan on holding the stock for 10 years, right? Then that's 10 years and 115% return. That's actually not worth it.
right. That's what you're saying.
All right. I need a 200% return for 10 years. All right, at least 200%. That's a minimum. All right. So yeah, it's always worth discounting. So if I can hit $5.64 over a 7-year period, sure, it's worth it. Yeah, then I believe the stock's worth it. No. Come over here. Come on. Let's go. You understand that though, Justin? So what we're doing by discounting further is we're essentially saying, if I'm going to take on this risk, what can I expect over the next business cycle from this company? Right? And when I say what can I expect, that doesn't mean I'm guaranteed to get this $5.64. We're saying, does it even make sense? Do I believe the stock can get here in 7 years? That's the question. Do you believe they can get here in 7 years?
And that they're down thinking the whole 7 years something with the bottom of the position or something.
Okay.
But even still, they're not a strong bottom. Even by system is still a strong bottom.
Yeah.
So I mean, I'm trusting the process. You know what I mean?
Yeah, I got you. Right. So basically what I'm saying to you is this, right? So what you do is you would analyze the stock, you did so, you know it's a strong buy, then you figure out what your holding period looks like. It's pretty much what I'm getting at, yeah?
Gotcha.
What's my holding period look like? Right? A stock that's trading closer to its target is what makes more sense. So that's why I have to discount it by so many years to get it closer to the target. You see? Does that make sense?
Yeah,
All right. So cool. I mean, a holding period of 7 years is probably max for me. You know, when I say max, I don't mean like I would never hold it. I would never own a stock for more than 7 years. I'm saying that's the max I'm willing to look at a stock and say, what if? I'm not doing any what ifs beyond 7 years. If I got to go beyond 7 years with a what if, there is no what if. I'm just not investing in the same. Okay. So, I mean, so now you have to decide for yourself if you believe this can happen. If you believe this can happen, then the stock is for you. Right? You got to weigh the risks and see how that's been playing out. That's how that works. All right. All right, guys.
right. Appreciate that.
No problem. No problem. So tomorrow night, actually, and so instead of doing discounted cash flows, I might come back again and maybe we use tomorrow night to practice discounting stocks, right? And see what we got going on out there in the market. What y'all think? Not tomorrow night, I meant Friday. What do y'all think about that? Y'all want to do some more discounting on Friday? Do some practicing? Okay. So that's what we'll do then. I will talk to you guys in the morning. I'll see you guys then. Looking forward to another great day in the market. All right. Everybody.
Question.
Yes, sir.
The formula for discount rate for the second discount rate. I'm seeing that you put down there D2 is equal to opportunity cost plus the risk premium times the beta.
Yes, sir.
And I see that in that column you got a .0060.
Yep.
Uh,
Because
so
the beta is only 0.01.
okay, but the beta is only at 0.01, but you're multiplying it only by the risk premium. When you add the opportunity cost of 13.5, hang on, let me see this. Yeah.
You see how it ended up?
Which we got the which the post in the wrong place.
Yeah.
The opportunity cost. That's E6. Okay, so E6 and A, and you're multiplying that by. I'm sorry. Yeah, you're adding those two.
Say it again.
Yeah, let me see that. Let me see that again. Go highlight that field again.
This field right here, yeah.
No, the discount, the number for that. It's on that.
So I'm taking the opportunity cost plus the inflation. So what we did here is we used two different ways to analyze the risk. We use a standard risk premium of 3%. That's what we use here, right? And then we use beta in the second version, you see, to calculate volatility risk in the stock. So we
I'm sorry.
I was going to say, so basically, so we took the base rate, and then we found two different ways to add a risk premium to it. And we took the average of those two. But for this particular stock, the risk premium is so low, you know what I mean? The risk premium is, I'm not the risk premium, the beta is so low that, it shows that you shouldn't, basically showing that you shouldn't expect much from this stock, is what it's saying to you. Does that make sense?
Yeah.
Right. So basically, anytime you get a low beta or you get a price that's trading well below, a price that's trading well below the target or your discount, it's saying that the market either doesn't believe that the stock is going to do well. It's saying that we shouldn't expect much out of the stock. Those types of things. It could be saying that the company's doing a poor job of managing things, or they don't like the way they're managing it. Even if the company looks quality on the surface, the market says what the market says, right?
Right.
So, but over time, the things that could happen with a stock like this, let's say, Justin makes the investment. Okay, well, 2 years from now, some other company starts to, like let's say JP Morgan starts to analyze the stock now, and now they want to add the stock and start monitoring it, and they boost the price target up, and all those different types of things can happen over time. All right. So who knows how they get to $5.89, or if they get to $5.89. But if they do, it'll be worth it over 7 years. Right? If 7 years comes around and they haven't done that yet, bye birdie. See you later, right?
Yeah, I agree.
Just get rid of them.
Chapter revenue. That's right, and the trailing 12 months, and the also
Mm-hmm.
went from a minus 4.61. That's for the entire year of 2025 to a 17.32 for trailing 12 months.
Mm-hmm.
So they can really kick ass in the last 6 months.
So Justin may be onto something, right?
Yeah.
He may be onto something. So
Well, picture is even quicker than that, because the trailing 12 months only goes to March, the end of March.
mm-hmm.
So my only question though, so I'm listening to how the market is giving such a low beta and saying it's not going to do well. How is it still coming up with a strong buy? I do think because it's been going on what they're doing in their performance, like their financials.
No. So their way of coming up with a strong buy is a lot different than ours. Right? We go strictly by the numbers, and then we use our ability to analyze the qualitative factors of a company to determine if that grade that we're giving the stock is a true grade or not, right? For an average analyst, they could be looking at like things that you don't even see. Like they could be in communication with the company saying, so what are you guys doing next year? You doing this? Okay, cool. And then they're factoring in. And so these analysts are usually assigned a certain industry or a certain sector that they focus on specifically, Justin. And that means they're going to have a certain group of companies that they're responsible for keeping in contact with. So let's say they say, oh, okay, you're in the automotive segment. So you're on the phone with Ford, GM, Tesla all day long, making sure that you know what the forecasts look like for the company. You're on the earnings call. You're the one that's calling in and asking calls on the earnings calls and stuff like that, trying to get all your projections right. You see? So that's how analysts will do that. Now, how he gets to 11, I don't know. But we really don't care how he got to 11 because we got it to 589. You understand what I'm saying? Whatever got him to 11, got him to 11. Doesn't matter much to us. What matters is, do we think the company's quality? If we do, how much below 11 do we really want to pay? And we know that's, at least 589, and we're below that as well. So, you know, you literally have just about 199% upside. So literally just about 200% over 7 years, if they can achieve this particular feat here, getting up there.
And I think it's at 589.
I discounted it by 7 years because of the high risk, right? One full business cycle, because as I analyzed it, it kept showing that it was really short of the target, right? So now the question becomes, let's go full business cycle, and now it's like, okay, cool. If I'm full business cycle now, what are the odds the stock can get to this price? Because we're not going to start talking about hitting $11 over 1 year. Does that make any sense to talk about? No, right?
Yeah, definitely not.
Definitely not. So you discount it further until the number makes sense to talk about. But you never discount past 7 years, because that's one business cycle. And nobody can forecast beyond 7, in my opinion. If they're doing it, then I'm sorry. I don't know what to say. I mean, 7 is the absolute point where I think everybody should just stop. Right? Because we've proven to have at least one recession every 7 years, at least every 7 years. Right? So and by the way, that's why 7 years, guys. If you wanted to know why. Right? We do 7 years because it's proven that you're going to have one recession at least every 7 years. So that means forecasting beyond 7 is like saying I have some sort of vision that nobody else in the world has. And I ain't never been that cocky, and I ain't never gonna be. I choose not to get punched in the mouth.
The code was a certain 20%.
Right. We're pushing it.
Activity right there.
Right. We're pushing it. I mean, and you could also say bear markets as well, Justin. So we've had 2 bear markets since COVID. So, so even though we didn't get the recession, we got 2 bear markets, yeah? So that still proves the point nonetheless. Right? So let's just say 2 market crashes. You know what I mean? Or at least 1 market crash, I should say. Right, every 7 years. That might be a better way to put it. You know what? It's been a while since we've been on this late. I guess we'll give Ishmael a chance. I guess he wants to say something, I guess. So Ishmael down there. I sent him an invite, he didn't come up, so I guess we'll go ahead and sign out then. I'll catch up with you guys in the morning. Yeah? See you guys then. All right, everybody be blessed.
Yeah.
Stay well, and I'll talk to y'all soon. Later. Later. Good night, guys. Good job, Justin.
Thanks,